By looking at scheduled risk events, you can find key turning points in the market. So looking at the Swiss CPI print on May the 2nd, there was a clear opportunity. The Swiss franc has been heavily sold off over the last few weeks. If you just take a look at the index level of the Swiss franc, you can see here, exactly what I'm saying with the deep sell-off. If you just look here, where are we? Just go back here, forgive me for this, there we go. You can see the Swiss franc, look, it's just been heavily sold off. And we've been expecting sellers and been taking opportunities as it's been sold on weaker inflation out of the SNB, expecting lower interest rates. So the Swiss franc has been heavily sold. So we knew that did give us a potential opportunity if we saw inflation for Switzerland coming in higher than markets were expecting. Then we recognized there would be an opportunity to buy the Swiss franc, not because it was a bullish outlook for the Swiss franc, but because of the stretch shorts would look to unwind quite quickly. Think about it, if you've been selling the Swiss franc on lower inflation and then all of a sudden you get a high inflation print, you also happen to be in a big support area, of course, it's only logical to take profit. So we wanted to see this print 0.3% higher or 1.3% higher, just to give us an indication that inflation is maybe a little bit more complex than markets were thinking. Month on month, 0.3%, and then looking for the headline figure to be, look, starting to move back up higher, okay, maybe heading in the wrong direction, just enough for those shorts to take profit. And in that case, we were looking to buy the Swiss franc, and we saw, yes, we got exactly what we wanted. Hot CPI month on month, hot CPI year on year. So buy the Swiss franc. And so that was event covered live. As we covered it live, we were looking for dollar Swiss franc sellers for spot traders and the 6SM contract for futures Swiss franc traders. And here was the opportunity. I personally took some longs on the Swiss franc, and you can see, look how price has been moving higher and higher. I wasn't expecting it to move this high, but I was expecting at least a retest up of these 1.1029 level. Did indeed get that, and good opportunity just to take profit. Also, we were looking at the dollar Swiss franc, looking for sell bias, and you can see I was looking for a retracement to 9140 for selling on the spot market. Didn't quite get the retracement to 9140, but I know some folks would have taken that, and you can see that has moved at least back down to test those spike lows, which is what you'd expect on a firmer CPI print out of Switzerland. So there you go. That's why we're looking at the economic calendar to find risk events like this, giving us high probability opportunities. Took a look at the calendar for this week. It is much quieter, and it's mainly going to be a UK focus. Let's just go through. So first of all, as we look at the UK data, the European data to start off Monday, we've got some Chinese data in overnight. We have seen some good, strong bids coming into Chinese stocks and shares, just as China's sentiment has pulled off from those worst levels. If that's a strong print on Monday, you could see a little bit more upside in Chinese stock markets. Looking at the Eurozone data, I'm not expecting anything from Eurozone data this week. We know what the ECB base case is, that they're expected to cut rates in June. And the wider question is, what's going to happen beyond June? So until we get some kind of resolution and some clearer picture on the outlook for Europe, certainly this final services HCOB data is not going to move markets much at all, so we don't need to look at that. The first event of any interest for this week is the RBA interest rate decision. Now, the last interest rate decision from the RBA saw the RBA shift, and they were sort of saying we're not ruling anything in or out with regard to interest rate moves. So there's just sort of hinting that they're not saying they won't be hiking rates, they're not saying they'll be cutting rates. There's a sense of ambivalence, in other words, data dependence. So if we look at the last inflation data out of Australia, it was firmer. The quarter reading for 2024 came in at 1% versus 0.8% expected, and the core reading came in at 4% versus 3.8% expected. So there is a bit more pressure potentially on the Reserve Bank of Australia. And if they sort of move back towards concerns about inflation. Maybe they change the wording, saying that they're not ruling out interest rate hikes. That's a way of hinting to the market that they're focusing on interest rate hikes rather than cuts. So if we see the language change, and I will have this updated on the cheat sheet, just explain what to look for as we get nearer the time. No change is expected, but if the language change back towards interest rate hikes being the more likely scenario for the RBA, then look for Australian dollar upside, probably against the New Zealand dollar. Going into early Tuesday morning, we've got German data out. Now, as I said, the outlook for the Eurozone is fairly straightforward. June rate cut and beyond there becomes a little bit uncertain. We've seen sentiment picking up in Europe, and the worst seems to be behind the Eurozone. So you might see a little bit of an uptick if we get any strong German data. It's the powerhouse of Europe. Strong German data tends to bode well for the whole Eurozone. Not something that I'm looking to trade, but nevertheless, we will take a note of the data, but there's not a high probability trading opportunity there with it. Going through, we've got some UK PMIs. I'm not looking at that as a potential opportunity. It's a smaller data point, and we've got the Bank of England meeting on Thursday, which is what we're going to be focusing on. Wednesday, very quiet day. More German data, which just builds into the general picture for how the Eurozone is doing, powered by Germany. But Thursday is the major event of the week with the Bank of England interest rate decision. Now, the last interest rate decision, we saw no members vote for a hike. And it was Catherine Mann, Haskell who were voting for a hike. They moved into the unchanged group, and Dingra remains voting for a rate cut. So what we're looking here for the Bank of England interest rate decision is quite interesting. Look, this is the pound on an index level. This was the last Bank of England meeting here. We saw the Bank of England, there was the two voting for a rate hike dropped. We saw the pound sell off. On Friday, Bailey says the path is now open for rate cuts. That kind of rate cut path was confirmed by Deputy Governor Ramsden, Bank of England's Green, Haskell. There was sort of, even though the UK latest inflation data had been a little bit firmer out of the UK, Ramsden wasn't worried, Bailey wasn't worried, Green wasn't worried. And in fact, there's a general sense of optimism that April CPI is going to be much lower. That was all great and rosy for the pound bears until Chief Economist Pill pushes back and says, oh, in my view, nothing's changed since March. So he wasn't encouraged at all. And then we saw the pound pull back right back up to that Bank of England kind of level. And then lo and behold, we found sellers again. The pound is very vulnerable to strong selling if there's a strong reason to sell. Now, the last Bank of England decision, the bank is saying, policy needs to remain restrictive for sufficiently long to return inflation to the 2% target. The committee has judged since last autumn that monetary policy needs to be restricted for an extended period of time until the risk of inflation becoming embedded above the 2% target dissipates. So obviously, if that sort of gets tweaked or removed from the rate statement, we're going to see some heavy pound selling. And if we just take a look at the pound at an index level, if there suddenly is a reason to sell, that would be a great area to sell the pound. And if we started to see these two unchanged, if 8 people voting unchanged, if any of them start moving to a vote cut scenario, and you sort of see, GDP, inflation expectations dropping, then watch out for heavy pound selling. We'll have a full brief and update as we get nearer the time. Friday, we also got the UK GDP data coming out. That can really move markets as well. So we'll be looking at that in line with the Bank of England interest rate decision. So again, very weak data out of here could really send the pound lower. If we have a more hawkish element there, if people have people moving back to a vote hike, then we could see another little leg higher in the pound. And then we'll be looking at the GDP very carefully. A big miss in the GDP, expect pound selling. A big beat, you expect a bit of pound buying. And it will depend how we trade this, what happens for the decision on Thursday. So I will update near the time on Friday. The only other sort of major event to be looking for is Canadian labour data that's out on Friday, 1:30. Now, GDP in the last week out of Canada show a drop for the 2023 quarter from 0.3 to 0.2%, and the inflation level is 2.9%. The Bank of Canada said they want to see and have confidence that inflation's on that sustained path lower. Macklem said on May the 2nd that the Bank just want to see that this is sustained, that they're heading down towards 2%. They said they don't need to get to 2% to cut rates. The base case expectation is the Bank of Canada will cut rates in June. You can see here there's 65% expectations that they will cut on the 5th of June meeting. That did bump up to a higher probability when we had that weaker GDP print on Tuesday, the 30th of April. You can just see expectations dropping. So more chance of a rate cut, 65% up from 40% last week. So the Canadian Labour data on Friday will be crucial. If we see a big miss there, then you'll see CAD selling because investors will think there's more chance for a rate cut in June. If it's a very strong print, then you like to see the CAD just pick up a little bit. Remember, labour market data is being viewed as inflationary or deflationary. Strong labour market is seen as inflationary, more people in work, they're able to pay higher prices, so that's boosting inflation, and that would support the CAD. Weak labour market is seen as deflationary, less people in work, Bank of Canada more likely to need to cut rates, and also less people able to pay higher prices, so it is CAD weakness. Okay, folks, that is all for this week. For all subscribers, they get an in-detail cheat sheet looking exactly what we're looking for before each event. So look out for that on the WhatsApp channel, and of course we'll be trading the Bank of England risk event live, and we'll be looking at that CAD CAD labour print, which will probably be the most interesting events of the coming week.